As mentioned previously, we're thrilled to have Henry here from VanEck, and they are one of the world's largest exchange-traded fund providers. They manage over $30 billion for clients that include asset managers, pension funds, sovereign wealth funds, and private clients. They allow investors to access opportunities in the global markets that might otherwise be unavailable to them. So I'd like to welcome Henry. Thank you.
Thank you very much, and thank you very much for having me. Look, I'm going to start off, I'll just introduce myself. My name's Henry Mortlock. I work for a company called VanEck Global, and we're a global asset manager. So we have managed investment schemes that we manage in the US and also in Australia. More recently, we moved out to Australia in 2013, since which point in time we've launched 12 ETFs on the Australian market. And those are designed to give investors like yourselves and financial advisors like Andy and Paul the ability to access opportunities in global markets rather than just looking at the opportunities in Australian markets. So what I'll do, I'm just going to start off, I'll just mention, as I said there, we're not financial advisors, we're product providers. Andy and Paul are able to help you out with a lot of the financial advice sort of stuff. I'm able to provide you with the information on the products, and I'm going to provide a few examples of how you could use ETFs in a portfolio if you're wanting to access some more diversification than what you already have. So firstly, I might just get a quick show of hands. Anyone who knows what an ETF is? A few? Anyone who's ever used an ETF? A couple, okay, good. So look, exchange traded funds, I think often acronyms are fairly scary to investors. Really, the reality of it is that exchange-traded funds are quite simple investment products. Like the name suggests, the exchange, they're on the ASX, they're regulated by ASX and they're quoted on market. In terms of traded, they trade like a share. And in terms of a fund, they're a diversified portfolio of shares that are managed by a professional, being ourselves. So when you combine those three things together, you get an ETF which effectively takes elements of shares and elements of traditional managed funds and combines them into one. So what do I mean by that? Well, in terms of diversification, an ETF has multiple shares. So it's not just one share. So it's diversified like a managed fund. In terms of pricing, it's priced on exchange. So all ETFs have codes, ASX codes, like any other stock. So if you speak to your stockbroker, if you go into your CommSec, your E-Trade account, whatever it might be, you're able to see the price of that fund at any given time throughout the trading day. That's different to managed funds where you'll get an end of day price. And same thing with executing. If you're looking to buy or sell, you can do that throughout the day on exchange rather than just taking an end of day price as you might with a traditional managed fund. In terms of management costs, exchange traded funds do have a cost embedded into the fund. Traditionally that is quite low because they are passive investment vehicles, be it that they track an index. Many of the traditional managed funds were active in nature, which can contain higher costs, but you can also get passive managed funds as well. So ETFs are essentially an evolution of investment product, and it's something that's grown a lot in the last few years. So just like the Nokia 3610 took over the telephone and the iPhone took over the Nokia 3610, ETFs have begun to take over managed funds and traditional platform investment products that were available. So it's a real evolution in the market. Now, the reason why it's not much bigger in Australia when compared to the US, if you look at the US in particular, you've got a total, and this is global, you've got 6,297 exchange traded products available globally. Now that accounts for around $3 trillion of funds that are managed in ETFs. When you compare that on the left-hand side there, you can see 2005, that was much smaller. You're looking around $400 billion managed in less than 500 available products. So it's been a drastically growing industry, but a lot of that growth has been concentrated in the US, and Australia seems to be just starting to embrace the products a little bit more in recent years. So I guess the main thing that you'll be wondering is, well, why the growth? Why ETFs, and what are the advantages of using these sorts of things in your portfolio? And I think really it comes down to diversification. So I've got here, there's a a picture on the left there, and it's by Money Smart in association with ASIC, and it talks about investing between the flags, which I think is quite an interesting topic because everybody understands exactly what we're talking about. When you go to the beach, you swim between the flags, you're safer, you're eliminating risks to the best of your extent. You're not completely protected, but you are eliminating risks. So when you're trying to invest between the flags, well, what exactly are you doing? You're trying to create diversification. And one thing that you'll hear fund managers, or you might see in the paper quoted, is strategic asset allocation. And what that basically means is that you have broad exposure to a large number of assets in various classes, and those assets will all perform differently in different economic environments. So over the long run, the more diversified you are, the more different asset classes that you have exposure to, you're going to get, hopefully, a smoother ride in terms of your investment portfolio. So, you know, I think Andy just made some great points there, focusing on investments, and a lot of that's targeted towards, let's say, for example, tonight, we're all balanced investors. Now, as a balanced investor, according to this Money Smart, you should have about 35% of your money in Australian shares. Now, can I get another show of hands who owns Australian shares in the room? And anyone own international shares? So probably about half of the people that had Aussie shares. Anyone that has bonds or fixed income? Not so many. So look, one thing that you will notice in Australia is that we are very much focused on the local market and we don't often look offshore. So in order to try and build out that diversification, I'm going to give you an example of an ETF, and it is one of our ETFs, that enables you to access opportunities in global markets via trading on the ASX through your regular share broker. So what are the reasons that you might want to get exposure to international shares? Well, if you look at the total market capitalisation of listed securities around the world, Australia makes up about 3% of the pie. So if you are just exposing yourself to Australian shares, you're missing out on about 97% of global investment opportunities. In terms of diversification, again, that can mean many things. So it can be geographic diversification in terms of natural disasters, as we saw in Japan a few years ago. It could be economic. You know, if you're just in Australian shares at the moment, you might be having some hardship because you're very exposed to China, as all Australian companies are. In terms of industry, you probably have a lot of banks and financials in your portfolio, but you mightn't have very much tech or healthcare or things that are larger in the US and Europe. And also political as well, you know. Political changes and sovereign risk definitely have effect on share markets. So diversifying your portfolio across many countries does help to eliminate that risk to some degree. And the final one is you are accessing the biggest companies in the world. I'm talking about Apple, MasterCard, Visa, Nestle. These are products that you would use on a day-to-day basis without even realizing it. They're big global companies and they're not just locally used products. It's around the world. So here's one particular ETF, and as I said, I'll just touch on one because I don't want to confuse the situation. But this is an ETF called the VanEck Vectors MSCI World X Australia Quality ETF. It's a big name, it's a real mouthful. But, and the code on that particular product is QUAL. Now this particular fund holds 300 companies from around the world, from developed markets only. So US, Europe and Asia, no Australian companies at all in the portfolio. And it selects those companies through a rules-based methodology that looks for companies that have high return on equity, stable year-on-year earnings growth, and low financial leverage, so they're lowly geared on their balance sheet. Now the net result of this portfolio is that through one holding on the ASX, you as an investor are able to access global shares through a single transaction. This would be held on your HIN or SRN number just as any other investment would. Now, the real advantage here, as I said earlier, is in terms of diversification. So as an example, I've got an Australian share portfolio. So this is the ASX 200 on the right-hand side. So I'd imagine a lot of your share portfolios look something similar to this, where you have almost 40% in banks and financials because people like income. You have another 15% in miners, potentially BHP, Rio, and a couple of smaller companies. And you have very little exposure to other corners of the economy that the nation is trying to grow. So in terms of economic exposure, you're quite concentrated in terms of sectors, and in terms of country exposure, you can see on the right-hand side there, you've got all your money in one country being Australia. Again, about 3% of the global opportunity set. So this is the sector and the country breakdown for our global quality portfolio. Now, you'll notice straight away that there's a bit of a difference in terms of sectors. The things that are big here, like banks and financial services and mining, is not necessarily big in the US, Europe and Asia. So straight away you'll notice that the biggest exposure in the portfolio is technology, something that represents probably 1 or 2% of the Australian market. Other sectors are consumer discretionary, healthcare stocks are quite big overseas as well. So you're getting a big mix of different types of sectors in the portfolio. Likewise, financials is only about 3.5% of the portfolio, so you have less exposure here than what you would on the ASX. In terms of country, you have around 70-75% exposure to the US, Europe and Asia making up the difference through various countries. So there's about 19 countries represented in this portfolio. Now one thing, I wouldn't say that with any of this stuff, one thing is better than the other, but what you're about to see is when you blend a portfolio using local shares and global shares, you can come up with quite a nice mix in terms of your diversification. So this is a portfolio I just blended together. It's got 50% of the quality fund and it's 50% the ASX 200. So now you've got the same top 10 shares from your ASX 200. You've also added 50% of the qual ETF, and you can see in terms of sectors, our financials, which was around 37%, has come down to about 20%. We've grown sectors such as IT and healthcare that have become a bigger part of the portfolio. In terms of countries, we're 50% invested in Australia. We have a large exposure to the US, where the largest companies in the world are. And then we have 19 or 18 other countries represented in the portfolio that are giving you that geopolitical, geographic diversification that we talked about earlier. So in terms of what that ends up looking like in the long run, Andy highlighted there that, the ASX 200 returned around 12% per annum, over the years since about 1900, I think it was. Now this chart, I think it goes back to 1994. And what it shows you is that no markets react exactly the same in different situations. So in the dark blue there, you have our quality ETF. In the sky blue, you've got the 50-50 blend. And in the orange, you've got the S&P ASX 200. So there are periods of time where the US and Europe outperform us. There are also periods of time where Australia outperforms Europe and the US. One thing you'll notice is that the blended portfolio in the sky blue tends to be in the middle. So you're getting that smoother return over time with this particular portfolio because you're better diversified. So that's really the thing with ETFs, is that through a single trade, through your regular share broker, through your online trading account, you can actually start to access opportunities. And it's not just in terms of global shares. If I take it back here, you can get ETFs that reflect bonds. You can get ETFs that reflect alternative assets. And you can get ETFs that can help you with your domestic share portfolio as well. So there's a wide array of these things available, and they're all designed to help you guys to build better portfolios so that you are more equipped to be able to invest between the flags. So with that, I might, I'll wrap it up there, but I would say, if you are looking at using these types of things, it's definitely a conversation that you want to have with your financial advisor. There's a lot of different ETFs out there. Some will be right for you, some will not. And that's something that guys like Andy and Paul or other financial advisors will be able to help you with, is picking the right product to suit your needs. Not everything's going to be right for everyone. So thank you very much. And if you've got any questions, I'll be at the back after and happy to have a chat. Thanks.